So welcome everyone to the second day of our second New York Fed FinTech Research Conference. I'd like now to introduce some pre-recorded remarks by John Williams, the President of the Federal Reserve Bank of New York.
Good morning. It's a pleasure to be opening the second day of the New York Fed's FinTech Conference. I hope that wherever you are, you're safe and healthy, and that you have a big pot of coffee brewing. There are lots of important issues being discussed today. Speakers will cover everything from big data to machine learning to robo-advising. And technology has revolutionized financial services several times over the past few decades. The conversations today will give us a glimpse into the future of how we can expect technology to transform the industry yet again. As we convene virtually on the backdrop of a global pandemic, it's clear that innovation is more critical now than ever. Access to banking services at a time when in-person interactions bring new risks, and fraud detection in a world that's increasingly moving online are just two of the challenges facing our industry. Today, I'm going to talk about what central banks are doing to confront risk and facilitate progress in innovation. But first, I need to give the standard Fed disclaimer that the views I express today are mine alone, do not necessarily reflect those of the Federal Open Market Committee or others in the Federal Reserve System. The global nature of technology and finance means that discussions about these issues must take place at the international level. If we keep our focus narrow, we'll miss the full picture of risks and opportunities that innovation has to offer. Earlier this year, the New York Fed became a strategic partner to the Bank for International Settlements Innovation Hub. The Innovation Hub fosters international collaboration on financial technology by bringing together the central bank community and engaging with innovators across the globe. With hubs located in central banks across Europe, Asia, and North America, this is an exciting and truly international effort. The New York Fed's work at the nexus of finance, technology, and payments means that we're uniquely positioned to make a valuable contribution at the international level on issues that will shape the future of central banking. Our relationships with other major international institutions means our work will be further amplified beyond the central banking world. Now, we plan to focus our efforts on the potential to improve the payments landscape, possibilities created by blockchain technology, the opportunities afforded by artificial intelligence, and the importance of responsible innovation. This is a deeply challenging moment for public policy. We're facing not just a healthcare and financial crisis, but also a moment of reckoning when it comes to racial justice and economic inequity. There's never been a more important moment to ask, how can technology help us to overcome these challenges? The New York Fed has a strong track record of bringing together academics, policymakers, and the industry on topics of critical importance, and today is no different. We will hear from some of the brightest minds solving some of the most challenging problems. So thank you for joining today's virtual event. I hope it brings us another step towards glimpsing the future of finance, technology, and innovation.
Thank you, John, for those remarks. So now we will start the first session of the day, and for that, I'm calling on Beth Cavanis, who is also along with myself, is one of the co-organizers of this conference. Beth, over to you.
Thanks, Asani. I'd like to welcome everybody to our session on using big data international evidence. Before we get started, I want to cover a few housekeeping items. Please note that the audio lines are in listen-only mode at this time. If you have any questions, you can submit them throughout the session through the Q&A panel on your screen or by using the raise hand feature, which can be found by your name. The questions will be answered either directly in the Q&A panel, during the Q&A portion of the session, or in follow-up communications. During the session, we'll spend 20 minutes discussing each paper, followed by each of the discussants having 12 minutes to provide their views, and then at the end, we'll have about 10 minutes for Q&A. So the first paper we'll discuss is FinTech and Credit Scoring for the Millennials, Evidence Using Mobile and Social Footprints. Sudeep Gupta from Fordham University will present. Sudeep, over to you.
Thank you, Beth. Thank you, Asani. I think, let me make sure that I can move the slides. The slides are moving, right? Yeah, great. Thank you. Thank you, the organizers, to keep the paper as a part of the conference. I really appreciate the opportunity to present to this audience. I'm Shudev Gupta from Fordham University, and I'm going to talk about financial inclusion and alternative credit scoring, role of big data and machine learning and fintech. A little bit tweaked title from the original paper we had submitted earlier. And this is a joint work with Shumit, Shashat, and Pullak. So credit access has been, as the president was saying a little bit ago, is a big challenge for all over the world, not only the central banks, but other policymakers too. We have people who probably do not have bank accounts, and even if they have bank accounts, they probably do not have credit access because they do not have enough credit history or credit scoring. So these individuals who could potentially be good borrowers and credit worthy are actually probably not getting credit, and that has a huge impact, not only in India, but also all over the world. And while credit history is actually absent, it's evident that because of the advent of the mobile phone technologies and the internet and social media presence has increased exponentially. And that kind of led to the question and quest for an alternative credit score that could we potentially use this alternative data that is out there, which is left by every individual. There are large stresses of data, and create something which might be reflective of how they behave when they're coming out to borrow. And that led to, of course, various different types of alternative credit score in the practitioner's world. The big picture question comes in here that can digital presence data be used to come up with an alternative credit score for unbanked customers who probably do not have either a bank account or even if they have a bank account, do not have enough credit history. Why do we care? Because it's actually a win-win situation. It's a huge untapped market. There is enough individuals out there. So if lenders can potentially expand credit and profitably expand credit by getting a better credit score, they can improve their own profitability. But of course, if the consumers and the borrowers who can borrow depending on their access and their needs, they could potentially improve their own welfare, which in turn potentially going to improve the overall growth and development of the economy. So this is why there's a huge policy implications of improving credit access through this other possibilities for alternative data. What do we know? We know that these alternative data, we have some preliminary evidences that they do make some impact on the default score, default predictability, and I have written not exhaustive, but a few recent papers which talks about how does this big picture question is related to the alternative data. The contribution of our paper is a little bit more than big, which goes beyond the alternative data and looks at, of course, the probability of predicting the probability of default is at the centerpiece of what's going to happen with alternative data. But moreover, we are interested in the prediction counterfactual. In other words, we want to look at that what would have been the impact on the loan approval and outcome if a social media-based credit score is used for denied borrowers. So this is the counterfactual who were actually denied because they didn't have a credit score. How many more could have been given approvals? What would be the overall default rate? And how does it affect the financial inclusion in certain sense for this particular set of borrowers who otherwise cannot access credit? And of course, all these things leads to a big estimation challenge because it's a big data problem. And this is where careful applications of machine learning techniques are relevant and necessary here. So this is the motivation. I have already talked about the motivation. This is the outline. I'm going to talk about the data. I'm mostly going to focus on the prediction counterfactual in the interest of time, and then I'll conclude. So mostly, let's talk about the data, which is one of the central piece of this particular research paper that we looked at. We have a unique data set based on one of the FinTech company in India, which is only a mobile-only FinTech lending platform. We have about 400,000 loan applications. The loan sizes are relatively small to moderate in Indian currencies. The duration is relatively smaller duration, short duration, 15 days to about 6 months. We have data about all loan applications from February 2016 to November 2018. So basically from the advent or the rise of the FinTech in India to the data as you could get. We have for every borrowers their loan application outcome. In other words, whether the borrower was approved or denied. And if they were denied, what was we have the same information that the approval data also have. And if they were approved, what happened to the outcome of the loan? Did the borrower actually defaulted, or did they paid up and stayed in good standing? We have various loan level information. Loan size, interest rate, duration, purpose. We have various borrower demographic information like age, salary, location, educations, credit score if available, and credit report, which goes beyond credit score, which talks about how much the debt to income ratio of that borrower is, what type of expenses they made in the last 3 months, and so on and so forth. A typical credit report that generally banks would otherwise get before they actually end up giving a loan. More importantly, we have information from the borrower's mobile footprint, various social and mobile data. So we have, of course, the mode of login, whether they logged in via LinkedIn or Facebook. We have various different types of apps, whether that's a dating app or financial app or social media-based app. We have the type of smartphone. We have their social footprint, which is related to how many people they are calling and talking each day, who belongs to their contact list, who does not, which calls are missed, which calls are incoming, how long are they talking. And we are going to use this particular variable and recreate a new set of variables based on these variables to measure various different types of social connectedness of this particular borrower. And then we match this data, since we know the location of the individual borrowers, we match this data with a separate data set, which has a financial inclusion measure, which is a district level measure of financial inclusion. And then we match this to understand where the borrower actually came from. And that is the database we actually later utilize to see the credit access approval or through this alternative means of data. The key findings, in the interest of time, if I do not have enough time to get through everything, that first, of course, the first order question, that alternative data actually have higher predictive power in predicting defaults. So that's the first important result that we have, that if we use alternative data, it could actually have a 10 percentage point higher variations of default predictability than if we just use the credit score. The number of AUC score is about 58.6 related to 69% when we are just using either of the two categories of the data. The second order information that we have is that, as I mentioned, that we have the information about the credit reports of some of the borrowers, and we use those information and call those as deep financial variables. And when we use the other information from the borrower's mobile phones and call them as deep digital variables, which relates to these contacts and social connectedness and call logs based data, it turns out that deep digital variable has much higher predictive power than the deep financial variable itself. So that's another interesting component. And most importantly, the prediction counterfactual that we are after, that we can actually improve credit access to those borrowers who were denied because probably they didn't have enough credit history or credit score. And if we still maintain the same level of default probability, we still could give 13% more borrowers without the credit score, which is CIBIL score in India. And they would have been approved. And this is going to be profitable from the lender's perspective, as well as, of course, borrowers are going to be given access to credit. And it turns out this improvement actually happens more for the low financially penetrated area. And this is where the financial inclusion data we use that helps us. And they would have benefited even more than the high financially penetrated area. So that's the one of the major important result, which has a huge social welfare implication of using the alternative data-based alternative credit score. So summary stats, I'll go very quickly in the interest of time. Importantly, we have borrowers who are relatively young. So this is why they're probably millennials. Think about these are the people who probably has a job, they're well educated, but they do not have enough credit history, and that's why they are probably not getting enough credit that they would otherwise get. We have various different types of loans, and these are all consumer loans. It's travel, consumptions, or medical. These are the different types of loans that we have. The typical approval rate by the current lender is about 72%. So if we look at the the overall summary of these two, you will see that the blue one is the people who has a credit score, and the other one is people who do not have credit score. So approval rate, it turns out that the current lender actually approves people, about 94% of the people who has credit score. So they have some kind of a preference for them, of course, probably because they have credit score. Out of people who do not have credit score, about 37% gets approved. So here you can see the problem of credit access to credit, probably because of lack of credit history. If we look at the default probability, it actually turns out to be the people, there is a marginally lower default for the people who did not have a credit score, but were approved by this lender. But if you, the bottom panel over here is looks at those people, the presence of the digital footprints and social footprints of the variables. And here we can see quite even distributions of different types of variables between even if you have a credit score or if you do not have a credit score. So this is kind of that alternative universe of data that we could potentially use for this group who were denied for credit, probably because they didn't have a credit score. A little bit of summary stats, which is done through a logistic regression, just to begin with, where I categorize the data under various different buckets. So we have loan characteristic categorization, borrower characteristic, credit score if it is available. Then these are the standard digital variables and many more, which kind of measures whether you have an app, how many SMSs you have, how many contacts you have, how many calls you make, what type of app you have, and so on and so forth. The deep financial variable is based on your credit report, which is debt to credit ratio, number of transactions in the last 3 months, expenditure to income ratio, average 2-month appreciation of account balance, and so on and so forth, as you would see in a credit report of one individual. And deep digital, which we create from the call logs data of the individuals. And we create various concentration measures based on their incoming, outgoing, and missed calls. And we know the duration of the calls, and we measure the overall concentrations to and see what type of people they're calling to measure some kind of social connectedness. And that's our deep digital variables based on the call logs. Overall, we mostly going to use the AUC measure to predict or compare between the predictability of the different models. It turns out, as I said earlier, that deep digital variables has much higher predictive power. And if you have all variables, of course, and this is, note that this is still in the simple summary statistics based on just logistic regression. I'll go to the machine learning component. Overall, economically, those variables do make sense, although note that we have close to 100 variables, so we have to be a little bit careful about the big data problem. We see the summary reduced from regression analysis that people who are taking what type of loan and what kind of expenses they're making, they kind of either more likely or less likely to be default, which has economic meaning and which kind of gives us some confidence that, well, these variables have some way of interpreting and it's moving in the right directions. So I'll skip and move to the prediction counterfactual problem to begin with. The prediction counterfactual problem, note that what we are after is we want to predict what would have happened to the borrowers who were denied credit. So it's a counterfactual. But we call it prediction counterfactual as opposed to causal counterfactual. It's not causal in the sense that by getting a FinTech loan of this small magnitude does not change the credit worthiness of the individual. So it does not change the credit risk of the individual. So credit risk of the individual remains the same, which is more like a rain dance versus umbrella problem, as famously put by Sandel's paper, that you want to invest in a rain dance to increase the chance of rain. That's a causal problem. But you want to predict whether there is going to be rain to take an umbrella or not. That's a prediction problem. And our problem is more like whether you want to take an umbrella out. So probability of rain is like more like probability of default. And that's what we are after. So again, as I said, that we believe, we make the assumption that credit risk is not affected by the loan approval decision. So there is no causal relationship. We still go through a prediction counterfactual relationship. I'll skip the details of this in the interest of time and make the point that what we are after is to find out how many more people would have been approved, what would have happened to the new overall default rate if we replace the high-risk borrower with a medium-risk denied or a low-risk denied, and of course, the implications on financial inclusions of that. So the way we do it, so if think about we have the total sample, we have this validation sample, or are those people who did not get the credit because they did not have enough credit history. But the approved sample, we break it down into 70-30, and then what I'm going to report, the 70% is the training sample, the standard machine learning training versus testing splitting. And then we do the cross validations to choose the best possible model to fit. We use various different types of machine learning methods, random forest, XGBoost, logistic regressions. And here we find out the best possible model here. And then we use the testing model, best possible model, which is predicted by the testing data, to the validation sample, which is out of those people who were denied, and then predict how many of those could have been given loan had they been given credit access based on the alternative data. So it turns out on the first stage, on whatever I'm reporting here are all testing AUCs. So it turns out the CIBIL score predicts only 55% AUC, whereas just mobile and social footprints, for example, predicts about 74% of the AUC, overall default predictability. So that's one of the first key component that this does impact the default probability a lot. This is the standard AUC curve. It does, that ranking is valid across different kind of heterogeneity of the borrower, whether you have a low CIBIL or high CIBIL, we still see the similar ranking, whether you have low financial inclusions versus high financial inclusions as defined by the Financial Inclusion Index, we still have the similar ranking, as well as other various types of demographic heterogeneity, low income, low education, high education, and so on and so forth there. The predictability AUC on the testing is kind of the same across various different groups. The ranking is kind of the same across various different groups and relatively more consistent. This is the ranking we have for the DIP Digital versus DIP Financial, and it turns out that DIP Financial actually predicts a lot higher AUC than if you just have the CIBIL score, which is close to 60%. But if you have this credit report based, if you use this call log based DIP Digital information, that is predicts a lot more of the overall default probability. And when we take this to predict the prediction counterfactual, as I outlined, it turns out the variables which mostly important in that first step of predictions are mostly social variables. This is the variable importance factor in the random forest, for example. And so you can see, I'm not sure if you can see it well, but the social says whether this variable has the higher predictive power. So most of these variables are social in nature. When it has higher predictive power. CIBIL does have a predictive power, of course, but social variables has much higher predictive power than the CIBIL. And if we look at, for example, this is the prediction counterfactual. So customers without the CIBIL score, if I want to, for example, leave one group and take a 3% predicted default probability, that in the counterfactual sample, my overall people who would have gained approval who were denied would have been 14% more. So this is one of our major credit access implications of the paper.
Sudeep, we have about 2 minutes left.
Thank you, Kathy. I'm almost, thank you, I'll be done in time. the similar things, that ranking is there across borrower heterogeneity. And I'll spend a little bit of time on this, whatever time I've left, on the financial inclusions. Here, the financial inclusion variable is measured by CRISIL, which looks at various measures. So one of them is, for example, fraction of household without bank account in a district. That's low is one, and then they have created an index based on that. So this is the index-based result. This is, for example, the fraction of households without bank account-based results. And these are the counterfactual that you could give, for example, about 14% of people without the credit score from low financial inclusion district who were rejected would have been approved with the default probability of 1%. And so this is the low financial inclusions, and the same number would have been about 10% in a high financial inclusion index base. So the impact of this alternative credit score on credit access is actually more pronounced in the areas where we have low financial inclusions there. I'll conclude. So in this paper, of course, there are more details in the paper, which is available on SSRN. We looked at the alternative credit score and figured out that the alternative data has much higher predictive power than the CIBIL score. The alternative credit score actually could predict and give access to denied borrowers who could have done even better by either lowering the default probability and getting higher credit access. So in that sense, our paper has implications for expanding access to credit or denied credit using alternative data. Thank you. I hope I'm not over time, Beth.
No, that was perfect. Sudeep, thank you very much. That was very interesting. Let's turn now to our second paper on high-speed internet, financial technology, and banking in Africa. Nicola Limodio from Bocconi University will present. Nicola, over to you.
Thank you, Beth. I'll just wait for the slides to be updated, and I'm looking forward to start. Fantastic. Okay, so first of all, thanks to Asani and the organizers to have this. It's fantastic, and I'm delighted to be with so many fantastic academics. This is, and not only academics, also people in, working on banking, regulators, private sector, NGOs. It's very refreshing, especially for someone being always in a university also now. This paper is joint work with Angelo D'Andrea, a PhD student here at Bocconi, and who does research on FinTech as well. Let me start by telling you that this is a paper on FinTech and banking, and well, there's been some research on these topics. There is an entire special issue by the Review of Financial Studies on this, and nice review paper by Goldstein, Jagger, and Caroli. One intellectual interpretation of FinTech so far is that financial technology lowers barriers to entry. So new companies started to compete with banks in mortgage markets, in consumer credit, in credit screening and scoring. And, the work by Sudeep is, in a sense, contributes to this. Technology is changing. We can process new information. New companies are jumping in. So, in a sense, a big message from this literature is that financial technology changed bank business outside the bank. What we are going to say in this paper is that fintechs can also shape business inside the bank. And we're going to study this by focusing on the interbank market, a specific technology, and a specific function. The technology is going to be the real-time gross settlement system, RTGS. And I will be telling you exactly what this is in a few slides. The function that we are going to study is that of liquidity management. Think about a model, theoretically, like a model by Patrick Bolton and co-authors, 2011. I am a bank, and I need to manage my liquidity because I need to pay out my depositors, I need to give loans, and so on. I store some liquidity. How can I do it? Well, I can either keep liquidity inside, I can hoard the liquidity, and this will have a certain opportunity cost. For example, the lending rate that I'm not making on this money. Alternatively, I can give out loans and I can rely on outside liquidity, borrowing from an interbank market, from central bank refinancing facility. And here there will be a certain cost gamma that can be a cost of transaction, of completing these transactions. The way that we interpret FinTech is that of a shock to lowering this cost of outside transactions, which will lead banks to change their optimal allocation of liquidity away from inside liquidity, away from liquidity hoarding, toward a more extensive use of the interbank market. And that's basically what we are doing in this paper. There are a lot of papers showing that mobile money helped individuals to improve their liquidity. We are showing that this is also changing retail management of liquidity and retail markets. How are we going to do that? We're going to be studying 489 commercial banks and 28,000 firms. We will perform a machine learning exercise to measure FinTech adoption at the bank level. And our key treatment is going to be the staggering of submarine cables that are reaching African countries in a staggered manner between 2000 and 2013. We will have different empirical models. First, we'll have an event study and a staggered difference in difference, leveraging country level variation. We will have a key heterogeneity focusing on bank level variation. We will identify supply and demand in a specific manner that I will tell you in a few slides. And finally, we have suggestive evidence on firms showing that they benefited from more active interbank markets. What do we find? We find that countries that receive a high-speed internet connection show a substantial increase in the probability of adopting this new financial technology. That's the real-time gross settlement system. This led to predictions in line with the theoretical model I told you before. Banks start holding less liquidity inside the bank, using more extensively the interbank market, and this led to an increase in private sector lending and in financial access. We study one key heterogeneity. We distinguish banks based on whether, before the arrival of the cable, they were active on the interbank market or not very active on the interbank market. We see that these banks that are not very active are those showing the largest increases in their interbank, in engaging with the interbank market and in giving more private sector loans. Finally, we have a way to identify. So we know that high-speed internet changed many things in Africa, demand and supply. We are giving you a channel through which the supply of credit is changing, and we offer you an exercise to distinguish demand and supply that I will present. Finally, we see that firms operating in countries with weak interbank markets are those that are showing the strongest increases in financial access, credit, loan maturities, and real variables like sales and workforce. Without further ado, let me tell you a little bit about our key experiment, which is the staggering of the submarine fiber optic cable in Africa. Before the arrival of high-speed internet, banks in Africa were relying for their RTGS operations on satellite technology. This is very expensive. Those of us that traveled in Africa and worked with African banks, as I did, they're aware that satellite technology is extremely expensive. To give you a sense, 1 megabit transported costs about $740. The arrival of the submarine cable lowered this cost down to 14.5, a 98% decline in the connection to an RTGS system. Now, how did the cable arrive in Africa? Many years. This shows you the cable arriving in 2000, connecting some countries in North Africa. This cable shows you another cable that touches the center and the south as well. And by 2012, 37, nearly all coastal countries in Africa were reached by a high-speed internet cable. These cables were not really meant to connect Africa to the rest of the world. They were meant to connect better Europe with the US and the US with Asia and this triangle. Along the way, Africa was touched as well. Now, how do we separately identify the effect of the arrival of the cable on the supply of credit, which is our object of interest, versus the demand of credit, which is, firms that get better opportunities and they demand for more credit? Well, we distinguish between when a bank is connected based on whether it's connected as its country is connected or as its bank group is connected. Let me clarify this. Take the example of Access Bank. Access Bank is a Nigerian bank operating across Africa. It's in Nigeria and in many other countries. In this specific example, it's in Nigeria and in the Democratic Republic of Congo. Nigeria gets the cable in 2002, while the DRC only gets the cable in 2012. Now, with this exercise, we're going to zoom in on the Democratic Republic of Congo, and we're going to be comparing a Congolese bank operating in Congo versus a Nigerian bank operating in Congo. And we're going to say the following. Well, the Congolese bank in Congo is treated in 2012, while the Nigerian bank in Congo is treated in 2002. So in a sense, we treat the Nigerian bank in Congo with the arrival of the cable in Nigeria. Why this is the case? Well, because once one of the countries, when the headquarter bank gets access to high-speed internet, the bank as a whole will get access to a deeper interbank market, and so will be able to more effectively borrow on the interbank market as a whole. There is a big literature on technology, FinTech, and liquidity and interbank markets. I won't spend time on this, also on some of the people available in this virtual room. Let me go to a roadmap and tell you a bit about interbank markets and subbank cables, a bit on data, machine learning, and empirics. And if there is time, as I doubt, I will also tell you about some of the robustness checks. Now, okay, so RTGS 101, we know that banks make payments to each other, loans, checks, wires. The old technology before the RTGS was the net settlement system. How does it happen? Very simple. Sudeep and I do transactions. Every now and then we sit down, we calculate our bilateral exposure. And if I have a debit with Sudeep, I will wire him a payment. Otherwise, the contrary will take place. Of course, if I have to wire a loan to Sudeep, he will be facing liquidity and credit risk. And this risk will be increasing in settlement lags, which are the time that require Sudeep and I to sit down and calculate these bilateral exposures. The new technology, the real-time gross settlement system, has a beautiful advantage that it's real-time and gross settlement. We don't sit down and calculate bilateral exposures. I have a payment, I send it immediately to Sudeep, he sends it back to me. And so this is basically eliminating liquidity and credit risk as far as possible. What's the problem with this? It is costly. Both Sudeep and I will have to adopt this new technology. We'll have to spend money to set up an operation department, and we'll have to spend basically the daily cost of getting these operations going. And as I told you, what the arrival of the high-speed internet does is to lower the operational cost of the RTGS by 98%. That's basically what we are studying in this paper. Now, how do we deal with that? We use data from BankScope, and let me spend exactly 0 minutes about this. This is standard. We follow standard cleaning protocol. Let me spend a little bit of time on what we do to measure RTGS. Data on whether banks have the RTGS are not publicly available. For example, in the US, the RTGS protocol is called FedWire, and unless I am a Fed employee, I believe at the Fed Richmond, and I work in that particular process, I don't have access to that source of information. So what do? Well, we have to kind of try to figure out whether banks have access to the RTGS. That's our primary object of interest. What we do is to go out there, and for 60% of our sample, we collect country and bank reports, and we look for information on when they disclose that they either adopted or they are using this new technology. For those banks, we code the RTGS adoption year and we put it together with some observables. And then we use standard tools from machine learning to predict. So we have 60% is our, in our training spot, and then we can we do training and testing, and we use standard algorithms, the elastic net, support vector machine, different type of trees and neural network. And our top performer is the bagging algorithm, which gets it right 75% of the time, which is much better than random guessing. And on average, we see that banks adopt the RTGS. Generally, 46% of banks adopt this technology. Now, what do? The first thing that we do is to run an event study, a classical event study, a certain variable observable for bank I, country C at time t. with bank and time fixed effect, and we do a typical event study window. After that, we go on a staggered difference in difference, and so our second equation, beyond having bank and time fixed effects, alpha I and beta t, we will have a dummy taking unit value when country C at time t gets the cable from that moment onward. What do we observe? The first thing that we see is that at the arrival of high-speed internet, while before the arrival of high-speed internet, countries don't seem to be different in their probability of getting the RTGS, whether they had the cable earlier or later. Once they get the cable, once countries are connected to high-speed internet, there is a much higher probability of adopting the RTGS at country level, so at central bank level, really. The second picture is our bank level exercise, and we find a very similar picture. We see that once internet arrives in a country and banks it is declining the cost of operating an RTGS, they are much more likely to adopt this real-time gross settlement system. In line with what I told you so far, this changes the way in which banks are managing their liquidity. We observe that liquidity holding, measured as liquid assets as a share of deposits and short-term funding, is banks that get the cable before or later are on parallel trends, but from the moment you get the cable, you start using a lot less. You start hoarding a lot less liquidity, which drops by an average of 10–15%. At the same time, you see that the use of interbank markets, measured as the logarithm of loans to banks, and interbank liabilities, measured as the logarithm of deposits from banks, starts actually to be much more, becomes positive and increasing over time. So we see that banks hoard less liquidity, use more extensively interbank markets. And as a result of that, because they're not keeping this bag of cash inside the bank, they can give a lot more private sector lending, and this is the logarithm of net loans given by banks. We recap these pictures with this table. Here we have the staggered difference in difference at country level. What do we see? We see that with the arrival of the submarine cable in a country, a higher probability of RTGS usage at country level and at bank level. And at the same time, we see what I just showed you, liquid assets on average declined by approximately 10%, which is, nearly a quarter of the average use of liquid assets. Loans to banks and deposits from banks are increasing, and so is private sector lending. At this point, we introduce an heterogeneity. So we interact this dummy DCT with another dummy, which basically tells you, before the arrival of the cable, are you a bank who was using the interbank market, little or a lot, simply defined by the median usage of the interbank market. And we study this interaction, and we see that banks that were weak users of the interbank market prior to the arrival of the cable are those that, with the arrival of the cable, are cutting their liquid assets a lot more. They are increasing their interbank. They're cutting their liquidity hoarding. They are increasing liquidity interbank assets and liabilities the most in private sector lending. And here we have bank and year fixed effect. You can introduce country year fixed effects as well. Finally, we try to address demand versus supply. How do we do this? Well, in the regressions I showed you so far, we were observing bank I operating in country C at time t. Now we consider that banks may also belong to multinational bank groups. And so basically, I will be considering not only whether a bank is connected because the underlying country of operation is connected to internet, but because the multinational bank to which this small bank belongs may be connected to high-speed internet as well. And that's exactly what I do in this regression. I always have a certain variable observed for bank I in bank group G, country C at time t, with bank and time fixed effect. I will now replace the dummy. Instead of country level, it will be at bank group level. Interacted also in this case with a dummy describing whether a bank was a weak user of the interbank market prior to the arrival of the high-speed internet. Our identifying assumption is that demand shocks are not differential across banks within the same group or country, and with a weak and a strong usage of the interbank market. Long story short, what do we observe? We observe results that are in line with what I told you so far. We see that while whether a group is connected or not does not really change the behavior of the average bank in terms of liquidity management, it does change it when banks that are belonging to a bank group is connected and banks that were, in a sense, out of the interbank market. These banks show a big decline in their liquidity hoarding, an increase in loans to banks and deposits from banks, and in private sector lending. In this case, we cannot just leverage, we are just using bank and year fixed effects. We can also include country by year fixed effects, which absorb the arrival of the cable in the country and may be absorbing any demand shock that may take place when internet arrives and firms get better business opportunities. And also bank group year fixed effects can be absorbed if we want to consider the removal of bank group wide liquidity shocks. So let me mention the last part here. So what have I been telling you so far? I've told you that when high-speed internet arrives, banks are much more likely to adopt a certain financial technology that improves their liquidity management. I've given you evidence that in line with a model, with theoretical models that are out there, banks change their liquidity management. And so one beautiful consequence of this is that there is more private sector lending out there. Now, in this part of the paper, what we show is, okay, do we see any evidence that there is an increase in credit condition for firms? So we download data from the enterprise surveys of the World Bank, where we observe repeated cross-section of firm F operating in country C at time T. And so we regress this with country and year fixed effects. We define a dummy taking unit value if country C at time T gets the cable from the moment onward and 0 before, and we interacted with a dummy taking unit value for those countries in Africa that have very weak interbank markets. And what do we observe? We observe that the arrival of the cable itself doesn't seem to be associated with significant changes in access to finance, bank credit, sales, or workforce maturities. But what we see is that the arrival of the cable in countries that have underdeveloped interbank markets seems to be generating an increase in access to finance, in credit, in sales workforce, and in loan maturities. So let me conclude, because I guess, Beth, I only have 1 minute or even less.
Yes.
Let me say that in this paper, what we do is to offer evidence that financial technology has an effect on bank business and bank liquidity management. The one-liner of the paper is that high-speed internet promotes interbank market in Africa. What do we learn? First of all, we learn that fintechs shape business inside the bank as well as outside, that fintechs alleviate frictions and improve capital allocation, and finally, that infrastructure investment improves risk sharing. This is true. Our colleagues studying trade have found these results, and finance will be just the trade of capital. These results should be out there as well. And I'll be doing more work on how to design financial institutions for development. And I am running a webinar on finance and development with Giorgio Barboli, Kaya Shaligis. If you're interested, please do get in touch. Thank you all for being here, to Beth for chairing, and to Asani and New York Fed colleagues for inviting me.
Thank you very much for that, Nicola. That was very interesting. At this point, we'd like to move to the discussant portion of our session. Our first discussant is Andrew Hertzberg from the Federal Reserve Bank of Philadelphia. And I will turn it over to you, Andrew, to provide some remarks.
Perfect. Thank you, Beth. So it's a pleasure to be here and discuss this paper. I make the usual disclaimer that the comments that I make here do not necessarily reflect those of the Federal Reserve. So let me start by saying, what is sort of the connecting big picture question that both of these papers are going after? And I think from, a question from 10,000 feet here is basically both of these papers are trying to say something very specific about what is the effect of technology on financial intermediation. And I think we all know that technology has massively changed the landscape of financial intermediation. But saying something very specific about how that change has actually taken place is more difficult. The specific questions that they're trying to answer here in the first paper is, how can we use the data that technology, in particular that smartphones have created, to do a better job of measuring a borrower's likelihood of repayment? And in the second paper, we're asking the question, what effect does access to the internet have on banking in Africa, or on the ability of banks to do their business, and the need to hoard liquidity and so on? And I would say that the sort of central challenge that both papers face is that technology just changes many things at the same time. So it's one of these things that we all know is true, that technology has massively changed the landscape. We look around, we see it every day in our lives. But then when we actually want to say something clearer, we instantly run into this problem that everything's moving at once, that the entire landscape of the world is being changed by the internet, that how we operate today, even this conference is so vastly different to anything that might have happened 10, 20 years ago, that becomes a big challenge. And related to that is that the way that people react to that technology is constantly changing over time, and the way they're using that technology is changing over time as well. So let me jump from that to make some specific remarks about each paper. So I'll start with the first paper. So here the question is, how do we do a better job predicting default? And I want to start by saying that the paper focuses on how correlated is some of the data that we get from smartphones with default. And I want to point out that I think they do a great job of establishing that, but that the things that we need for a piece of information to be useful for credit scoring and lending sort of on a sustained basis would not only be that they would be correlated, but that relationship is relatively stable over time, that I can use a relationship that I've estimated before to predict in the future. And related to that, but somewhat different, is that once I start using that, it's not easy for borrowers to manipulate any of that piece of data so that they could essentially disrupt the correlation that I was originally using to predict default. And so I want to try and say a couple of things about the specific measures that they have and how they fare on these other two measures, which aren't really addressed in the paper. So I sort of view that the paper is doing a good job establishing, one of the three things that we would really need if this was actually going to be operationalized. Now, first, I want to start with this question of stability. So I don't have anything extremely. I don't have it. I'm going to just make some vague remarks about this. So the first is I'm going to look at table 1 in the paper, where they present the sort of simple difference in averages for many of these variables across defaulters and no defaulters who are given loans at the bank that they're working with. And we see for some variables, it's just a very marked difference. So for example, the number of calls, the number of text messages is a very big difference between defaulters and non-defaulters. But when we go to a lot of the other variables, we see that, for the number of contacts, I also don't understand how people can have 823 contacts, but I'm thinking about that the wrong way. Or maybe I'm just a lonely guy, I don't know. But there's, there's a gap there of 20 or so contacts. And you could imagine that, people are using their phone, they're adopting this technology. This is changing over time. That difference could easily disappear in a very short period of time. And when we look at many of the other measures, we see that there's a difference between defaulters and non-defaulters, but it's pretty small. And if this was going to change, if the number of people using Facebook or LinkedIn was changing rapidly over time, then these differences in averages across the two groups could very, very easily evaporate or could change markedly from one period to the next. If we look at the types of, the number of apps, there's a sort of noticeable difference there, but in terms of, the types of apps that people have, there's very little difference between the two. So I'm not saying that they don't predict default now, but I'm saying that, it could easily be that, the small difference we see in the, adoption of travel apps between these two groups could easily be changing over time, and could essentially render the prediction power that we have in this sample not particularly useful later on. So what would I say more productively about this is that they have a sample of 34 months. So I'd like to see some evidence. How much are these variables changing over the sample for defaulters and non-defaulters? And do we see that correlation sort of behaving in a relatively stable way? The paper particularly makes the point that we could use this data to, extend credit to sort of more marginal borrowers. Do we see the correlation is particularly stable amongst these borrowers? If it was less stable there, then we would be more worried that conclusion doesn't really apply. So in terms of the stability, I would sort of say I would need more evidence to be convinced. In terms of, suppose that a lender did use these categories, I'm also concerned that they would they could easily be manipulated by borrowers once that practice was established. So maybe for the number of calls and text messages, that wouldn't be so easy. But if simply having an app on your phone could change your effective credit score, then you could easily imagine everyone would go out and download those apps and would essentially render that very, very, useless in a hurry. If many people are on Facebook, but the choice to log on to this website through Facebook or not changed your credit score, that could very easily be manipulated and would sort of render this not particularly useful as well. And if we go to the other categories, I would say make the same basic comments, is that it's not clear to me that they would be stable or free from manipulation as well. And I think maybe more thought needs to go into thinking how to measure this manipulation. That's less obvious without having watched that actually happen. Okay, so now let me move to talking about the other paper. I realize now that all the animations that I put into my PowerPoint slide don't work, so I have to. You have to imagine the blue box drifting down to the second one in a shower of PowerPoint display. Okay, so the second paper is asking what is the effect of the internet on our financial intermediation, and I think the starting fact here is that the adoption of this real-time gross settlement system seems to show a very marked increase after we see a country adopting the internet or having the internet essentially delivered to their country through the connection to the submarine cables. And I think that's pretty clear. And as they say in the paper, it's not altogether surprising because in a sense, the internet is basically a necessary requirement for that. And you'll notice that the RTG adoption then happens somewhat gradually after that. It's not as if there's an instant jump that sort of, everyone is now on the RTG system, but it sort of starts the process whereby countries now adopt this system. That's not the main focus of the paper. So the main focus of the paper is to say, well, that then the RTG system then affected the way banks did their business. And I want to make a few comments about that. The first is that the way the authors sort of interpret most of these pictures, it would be to say, here is a measure of, how much banks hoarded liquidity prior and after the connection. And that there seems to be sort of, the data points would suggest a sort of discontinuous jump down around the adoption of the internet. But it's not obvious to me that that in many of these pictures, I could also just as easily describe that as a sort of trend in one direction or the other. That the hoarding of liquidity was lowering over time in African banks, and it just happens to be that in the middle of that, we connected to the internet. And I'm not going to go through all the other pictures that Nicola put up, but I think for many of them, you could roughly make this case. And I'm not saying that that's kind of like the final word on this, but it is a cause of concern. The next thing that I want to make is that the central question here is, are we asking what is the effect of the internet on banking, which is in a sense the source of variation that we're using, or what is the effect specifically of the RTGS system? And that's a little bit harder to disentangle. And many of these pictures don't really tell us very much. And I think a lot of the regressions that are presented in the paper sort of fall into the same category. But the paper does grapple with that question. And I would say that I would in fact encourage the authors to move to this analysis as sort of the forefront of their work, because I think this is the central challenge that you face if you're trying to write this paper. And so here they say, well, let's actually take away all of the variation that's going on in each country at each moment in time. So that's just using these country by year fixed effects as they do in Table 5. And let's use as a counterfactual weak, or as a comparison, weak and strong banks. So these are banks who are more or less connected to the internet or the internet bank market prior to the adoption of the internet. And we see, as they sort of predict, that banks who were less active in the internet bank market prior to connection to the internet, it's them that, for the key outcome variables, that they seem to have the bigger effect. And so that's sort of suggestive that it's not just that the economy in these countries is changing because of the internet, that there's actually something going on about the differential effect of the internet. And I would say that that's kind of like the most compelling evidence and should be the sort of the forefront of the paper. We shouldn't sort of have to wait till, Table 5 or 6 to get there. to sort of see that. That would be my first comment. The second comment is that then I would sort of bolster that by showing me that this is really a rock solid comparison that I can believe in. You know, are strong banks a good counterfactual for weak banks? Do we see that, you know, there are parallel trends in the way these outcomes evolve over time for each of these two groups? And does that trend then break as one group sort of is more disproportionately affected? And to show us what else we know about these weak and strong banks. Do they differ in the types of lending they do? Do they differ in the types of customers that they serve? And might that also have been another channel through which this effect of the internet differentially affected them rather than just access to the RTGS system? Okay, and I think with that, I'm out of time.
Thank you for that, Andrew. Let's move now to our second discussant, Melissa Koida from FinReg Lab. Melissa, over to you.
Thank you, Beth. Thank you, Asani. It's a pleasure to be with you, and it's a real pleasure to be talking about these two papers. For those of you who may not know who FinReg Lab is, I just want to quickly introduce ourselves. We're a DC-based 501c3 research organization that I stood up after leaving the U.S. Treasury Department with the purpose of undertaking empirical research to help inform public policy and market practices in the adoption of particular data uses or technology uses in financial services. And I would explain our true north is sort of evaluating data and technology for the safe adoption, ultimately for expanding financial inclusion and financial access. We are largely focused on the domestic US financial sector, but hopefully some of the insights that I bring to this conversation today will be important for contemplating the implications of these two papers in other countries and in the global context. So it's a pleasure to be with you. Let me make sure I know how to move myself through our slides. So as everybody knows, I'm going to share some perspective, both from what the implications of the research are that are presented in these two papers for public policy, for market adoption. I want a table set also at the start. There is, I think we all realize, tremendous interest in the potential of technology and data to lower the cost in financial services, to improve accessibility, to ultimately enable a more personalized and at times nuanced ability to provide products and services to consumers and small businesses and the broader marketplace. And ultimately in the global context, to help to address the 2 billion individuals across the globe who lack access to safe and affordable financial products and services. There is a particular interest among banks, fintechs, investors, policymakers, advocates, in how new data, new technology can actually help to expand prudently, but also affordably credit to underserved markets. And so I think the research that we're going to talk about today really helps to expand our general understanding about even non-financial data and where that type of data may be instructive for credit risk assessment. Here in the US, John Williams said this at the start, we are in a moment in time where both we have enormous social unrest and concerns about the lack of fairness and access to the financial system, to wealth building opportunities, to employment. We also are in a moment in time when we are under a global pandemic, and even here in the US, where we have a credit system that is known for its ability to leverage data for credit risk assessing financial participants, even the traditional data that we rely upon is being questioned in terms of how it's able to really risk assess in these moments of real shifts in employment and ability of individuals to be meeting their credit needs. And so there is a real press for understanding, are there other data that may be instructive for credit risk that may provide more timely information about credit risk? And so I do think, too, this looking at alternative data may offer some insights there. So these two papers, I will join Andrew in saying, are really instructive for thinking about not only the implications of the deployment of technology on more of the retail side of financial services, but also importantly thinking about the implications of how technology deployment is helping to drive cost efficiencies when it comes to liquidity and interbank lending. Together, I think these two papers are helping to inform how tech and data can help to facilitate both increased financial product availability, and I think that's an important piece of this, and lowering costs, but also really driving the ability of the financial sector, whether it's the banks themselves or non-banks, to evaluate risk and thus be able to get after markets that traditionally have been underserved. So I've always considered and thought about, or early on had thought about becoming an economist. I am not a PhD economist, and so you're not going to see that level of analysis here. And I'll share some of the work that we've done, however, that is really focused on the evaluation of non-traditional data. But I wanted to make some top-line remarks and some, I think, hopeful comments for you, Nicola, on the paper that you all have put out. You've heard sort of a deep explanation of the theory behind how this technology adoption, high-speed internet access may ultimately be helping to drive the availability of private capital in African countries. And everybody understands how the evaluation has taken place for that assessment. And I think some of the key findings that are instructive are, you do point out the increased interbank activity and a number of other sort of core findings that ultimately lead the reader to conclude that high-speed internet is promoting private sector lending by the banks, as well as credit and sales by firms. My questions for you that I think would be fantastic to probe further are issues around who are those firms, and ultimately how are the markets in these African countries, especially where we know there are such low penetrations of bank access, payments access, credit access, whether it's to the consumers themselves or to the small businesses. Who are these firms who are themselves actually the recipients of the capital, and how is that actually translating into potential benefits for financial inclusion? I was actually listening really closely, hoping you were going to even further articulate who those firms are. Maybe we can follow up and talk about that at some point. But I think this notion of sort of how the technology is ultimately having this impact in terms of driving capital access at the local level is something that would be great to probe further. Another consideration in looking at the implications of reduced costs and the availability of capital are questions that get raised in terms of how the institutions, the banks themselves, are taking advantage of those resources to themselves potentially be the provider of capital and credit to populations. And I know this isn't something that you had contemplated at this point, but I think that kind of insight would be really instructive for understanding how does something really on the sort of infrastructure side and driving real-time gross settlement opportunities and greater liquidity ultimately translate into what the banks themselves are doing. There are lots of other ways in which high-speed internet can be useful for the banks to be taking advantage of data that they themselves are already sitting on in terms of who their current customers are, or leveraging other data that may be coming in from other sources. So again, I'm not an economist to critique the paper, and I appreciate hearing Andrew's comments, but I do think from a market implication, and I think also questions that would be raised from a regulatory standpoint, really trying to understand how the benefits of the technology ultimately result in greater capital and credit access at the consumer and the firm level would be great to probe further. So now you're going to hear me actually turn to the paper that is more closely aligned to research that we have done at FinReg Lab. You've heard all of, again, the description of the theory, We do have a lot of people across the globe who are insufficiently credit risk assessed using traditional data. Just to contextualize that, in the US, we have up to 60 million US adults at any given point in time who are considered thin file, no file, or non-prime, whereby there is increasing belief and increasing confidence that leveraging new types of data, whether it is non-traditional financial data, what we call cash flow data, or other types of data that are talked about in this paper, may be quite instructive for credit risk assessing populations. Lots of really useful and insightful findings from this work. I mean, but just to recognize the paper finds looking at social data, mobile data, deep financial data, each of these different types of categories of data were found to be predictive of risk. And also, as we heard the author explain, these data, if used, may actually have enabled the lenders to say yes to people who they otherwise would have said no to. And that's a really important, I think, insight from how are we making sure that we are fairly extending credit to populations who may otherwise be turned down. So just to point out some of the particular findings that I think are going to have relevance to some of the policy and societal and market adoption, importantly, questions are some of these: the evaluation of social footprint and deep social footprint information. Really interesting that depending upon if you have a financial app on your phone, it has an implication for your likelihood of defaulting. I don't think intuitively that surprises anybody. And the authors hypothesize this is in fact because we're actually not just understanding, are they using the app, but we're actually getting a sense of behavioral indicator information. At some level, even looking at financial data that is giving us some sense of the individual's behavior. But when we're going as far as looking at non-financial data, what apps does a person have on their phone? Are they financial? Are they dating apps? These are moving us into new territories that I think invoke a lot of questions that we haven't contemplated to date about what type of data are we collectively, individually comfortable in terms of being used for evaluating our credit risk. So the deep mobile footprint data was found to have greater credit risk prediction as compared to the deep financial information. And the deep financial information and deep mobile footprint variables, and I think this is important, do have significant discriminatory abilities to predict risk. And that actually comports with some of the research that I will show you in a minute that we have done, whereby it is important to realize that these different types of information that are potentially indicative of individual behavior are offering nuanced and different assessments of risk, which ultimately may help to drive out the predictive power or the AUCs of the data. So now let me turn and just sort of contextualize how I have thought about these questions with respect to policy and considerations.
Melissa, we have about 1 minute left.
Is that it? All right. So we looked at questions around predictiveness, inclusion, and fairness. And I am going to quickly show you in a similar way, and you can see this research in our papers, but we too find if you're starting with credit bureau data, you get so much of a lift. When you bring in additional financial data, it is helping to push out and offer nuanced information that otherwise you wouldn't get with just credit bureau data. So I think it's helpful to see similar AUC trends between the paper's findings and the research we did. I'm going to skip this one, but it is an interesting heat map that would be worth looking at. And ultimately, thinking about the mobile and the social data, is it indicative of credit risk? Yes. Is it inclusive? Yes. Are there a lot of questions that have to be considered? Here in the US, we have concerns about fairness, both making sure that people get credit, but also fair lending questions around, are there protected class populations who are treated differently vis-a-vis the data that you're used? Clearly, that would be something to be thinking about. Open questions about privacy, explainability. Here, Andrew, I might disagree with you a little bit. Legally, there is a requirement in the US that you have to be able to explain what were the main 4 variables or characteristics that drove a particular outcome. There's also some interest in from a policy standpoint, even among policymakers, of the need to be able to explain what those variables are so that the consumer could potentially have some direct effect in the ability to lift their score. So it might be something for us to talk about. And then market implications. How do we contemplate how using these non-financial data for populations who are not scorable under bureau data potentially set up this risk of sort of this 2-tiered system where I have to share more of my private data, my sort of behavioral characteristics, where somebody who is older, higher credit score doesn't have to share as much of that type of information. So all to say, these are factors that I think, as we think about the potential benefits and the inclusion benefits of expanding the data, how are we solving some of these consumer protection expectations, privacy, as well as open questions around, are the data predictive over the long term? Thank you, Beth. I know I went a little bit over, but I appreciate the time to finish it.
Oh, no problem. I think, thank you to both of our discussants. I think they raised some very interesting questions. I wanted to, before we move to the Q&A, give our 2 presenters the opportunity to respond to some of the questions that were raised. Sudeep, Nicola, do either of you have any comments you'd like to raise?
I'm happy to leave to Sudeep the first part.
Thank you, Nicola. Thank you, Beth. And thank you, Andrew and Melissa. Thank you for this great discussions. I really appreciate both the points. I'll go to Andrew's points first. Yes, I completely buy the stability over time and the manipulability are 2 important issues to consider as a paper. The first one we have actually some answer. The second one, I'll talk a little bit about it. The first one, given the previous referee's report, we actually moved our focus of the paper to more on trade access and counterfactuals. The current paper stands at 70 pages, so we actually took out from the previous version, if you had seen that, a lot of those descriptives and potential time-varying things. So bottom line of that, we did look at the stability over time of these different variables and see whether they really were different, as well as we did this counterfactuals over different periods of time too, to see whether they actually was a time inconsistent pattern over there too. So thankfully we didn't have that. Probably I should put that up as an internet appendix just to make sure that all this information is put up there. So that's the first point, stability. The second point, manipulability, I agree. There is, like, for example, eBay, when eBay first came in, everybody was bidding probably naively. Now you know that there are so many other different servers comes up which bids for you. So whether people could manipulate or could there this kind of services come up which might affect manipulation, these are very important policy questions. This is but again, in the interest of the referee, in the interest of the size of the paper, we didn't approach that and put it on the credit access and the counterfactual. Some of them actually we are already working on as the different algorithms to affect manipulations and so on and so forth. So hopefully we'll work more on that. Melissa, thank you so much. It's great to know that you are working on these topics too, and would love to connect. In the interest of time, I don't want to take Nicola's time, given that we are both in New York City. We'll love to connect afterwards. Thank you for the comments.
Thank you, Sudeep. Andrew, I really like the discussion. I agree with you that we are a bit, at a phase in which we need to decide, are we studying the RTGS or internet? And to what extent do we want to focus on, the FinTech adoption part? Is that, in a sense, shall we be a little bit less orthodox on the supply demand? Can we, that's, we're still thinking how to, reframe a bit the paper. Given, some experience I had talking to bankers in Africa, I had a clear view at the beginning, but now I probably need to abstract a little bit and, also, use all the wonderful feedback I've been receiving, and what you have is precious, so very, very important. I'd be very happy to consider, what you've been writing. Melissa, thank you very much for raising very cool questions. To be honest, I want to. It may sound just cheesy, but it's a very interesting format to have an academic discussion. I mean, like Andrew, top-notch economist giving me advice, and someone who is not a PhD economist, so bringing a fresh perspective on these topics, which is something which is valuable. I find it to be very valuable, and I'm not sure I'm able to answer nearly any of the questions you highlighted, not for a lack of interest or a lack of empathy, but simply because I do not have the data to do that.
Sure.
So, but those are important questions, and I'll write you privately. I'd be very happy to get the slides and think whether, to some extent, at some point, in some dimensions, I may have more convincing answers. So, thank you once again, and have a great day.
Thank you.
We are running a little bit tight on time, so what I'd like to do is extend my thanks to our presenters and to our discussants. I think this was a very interesting session. If attendees have particular questions they would like to pose, I would like to suggest that you put them into the Q&A panel on the right side of your screen, and we will respond to those offline. Asani, I'd like to turn this back over to you. Thank you.
Thank you, Beth. Thank you for moderating that session. Thanks to all the speakers and discussants. That was super interesting. And I would just like to remind everyone that we have a 10-minute break, and then we will come back at 12:30 for the next session. So I'll see you then. Thank you.